Nobody seems to be talking about what just happened, and that silence should bother you. The jobs numbers dropped. Headlines screamed strength. Markets cheered. Gold and silver instantly got slammed lower, exactly like they always do when good economic news appears. But here's the part almost nobody reads. Buried in the revision data was an admission. Employment had been overstated by more than 1 million jobs. Over a million, quietly adjusted months later, when nobody's paying attention anymore. At the same time, over in Asia, something completely different is happening. The Shanghai premium on silver just doubled, jumping to around $6. Physical buyers are paying far above Western paper prices to actually get metal in hand. So one side of the world says everything is strong and under control. The other side is scrambling for physical supply, and most people never notice the contradiction. If you're new here, your first instinct might be, this sounds like conspiracy talk. And honestly, that reaction is normal. It's almost automatic now. People have been conditioned to dismiss uncomfortable information immediately instead of checking it themselves. Because skepticism today flows in only one direction. People question independent sources, but rarely question official narratives. And that imbalance benefits the institutions. They don't need everyone convinced. They just need most people to stop looking deeper. This channel operates outside that system, and that's exactly why videos like this don't get pushed by algorithms. You probably didn't see this recommended. You probably stumbled onto it. And that's fine, because I'm not asking you to trust me. Trust is irrelevant. Verification matters. Pull up the settlement records. Read the exchange delivery notices. Look at the commitment of traders' reports. All of it is public information. Nothing here requires belief, only effort. And the people who actually take the time to verify the numbers always end up seeing the same pattern. When you can look up court case numbers, settlement amounts, and actual admissions of wrongdoing, the conspiracy label disappears pretty quickly. Now, quick heads up. I've just uploaded the first video on the backup channel. And if you've been following this channel for a while, if you're one of the people who actually checks the data, then I need you to go watch that video and subscribe there as well. This isn't promotion. It's preparation. Channels like this get buried, throttled, or removed all the time, especially once discussions start hitting sensitive topics. We've already seen signs of shadow suppression here. So if this channel suddenly disappears, you'll know where to go. Backup channel name, OG John AG_2. Link is in the description. There's only one video there right now. That's how you know you're in the right place. Watch it. Subscribe. Be ready. Now let's look at prices at the time I'm recording this. Western silver spot sits around $84. Futures slightly lower near $83. Meanwhile, Shanghai spot prices are trading close to $90, with futures even higher. That gap, roughly $6, is massive. And remember, just days ago that premium was closer to $4. It has nearly doubled. Don't take my word for it. Shanghai Futures Exchange data is publicly available. Anyone can check it. So what actually triggered today's chaos? The headline jobs number came in stronger than expected. Markets reacted instantly. Precious metals got hit, the usual algorithmic response. But once analysts looked past the headline, the revision data told a completely different story. Prior employment numbers were slashed downward by over 860,000 jobs, marking the largest downward correction since the financial crisis era. When you combine all revisions, total job growth for the entire year drops to around 180,000 jobs. That averages out to barely 15,000 jobs per month. For comparison, the previous year showed over 1 million jobs added. That's not a slowdown. That's an economic engine stalling. But revisions get released quietly, months later, when markets have already moved on. And this isn't new. The same downward revisions happened in 2023, then again in 2024. And now even more dramatically in 2025. At one point, employment was overstated by more than 1 million jobs compared to actual payroll records. Yet gold and silver still got hammered on the initial headline release. And now, both metals have already recovered most of that drop. Gold is even pushing toward new breakout territory again as I speak. Because underneath the paper price action, fundamentals refuse to cooperate with suppression attempts. And here's where things start getting interesting. February silver deliveries on COMEX just surged to levels rarely seen. Over 23 million ounces requested for delivery. That translates to more delivery notices than total open contracts that existed when the delivery month began. In simple terms, more people demanded physical silver than there were contracts originally open. That's paper positioning being overwhelmed by physical demand. And again, these delivery reports are public. Anyone can verify them. Now look ahead. March silver contracts currently represent claims on roughly 340 million ounces of metal. And February 27th marks the first notice day, when traders must either prepare to deliver real metal or settle contracts. If delivery requests stay anywhere close to current levels, the exchange will face one of the biggest physical tests in modern trading history. And almost nobody in mainstream finance is talking about it, because headlines are still focused on jobs numbers that were quietly revised down later. And this is where timing becomes critical, because another major event is about to temporarily remove a huge physical buyer from the market. Here's the timing element almost everyone missed. The Shanghai Metals Exchange is shutting down for the Lunar New Year holiday, closing from mid-February through the following week. For roughly 8 days, the largest physical metals market in the East goes quiet. No major Chinese buying activity. No daily price discovery from that side of the world. And historically, this window creates opportunity. Because when Eastern buyers step away temporarily, Western paper markets suddenly have far more control over price movement. Banks and large institutions know physical demand isn't there to absorb aggressive paper selling. So during this period, prices often get pushed lower through futures markets. On paper, it looks like metals are weak. But this year, something is different. Before the holiday even begins, China's silver market is already flashing warning signals. Shanghai futures have entered record backwardation, meaning near-term contracts are trading higher than future contracts. In normal markets, prices are higher for future delivery due to storage and financing costs. Backwardation flips that logic. It means buyers are willing to pay more right now rather than wait. And that typically signals one thing: immediate supply shortage. Inventories available for delivery are shrinking while demand for physical silver, especially from investment buyers and solar manufacturers, keeps rising. Some traders holding short positions are even paying penalties just to delay delivery obligations. That behavior isn't normal market functioning. That's stress inside the system. And this tightening situation in China lines up with another broader shift happening globally. Silver concentrate and refining flows are increasingly being redirected toward U.S. and Western processing channels due to geopolitical restructuring of supply chains. So while Western paper markets pretend supply is stable, Asian markets are dealing with real physical pressure. And this connects directly to the economic picture nobody links together on mainstream financial news. Because while employment headlines claim strength, real economic stress is building underneath. Last week alone, 9 large U.S. companies filed for bankruptcy. The 3-week average of major corporate bankruptcies now sits above 6 per week, levels last seen during crisis periods. Meanwhile, consumer debt delinquencies continue rising. Across all household debt categories, credit cards, auto loans, personal loans, delinquency rates have climbed near levels not seen in almost a decade. So step back and look at the contradiction. Employment supposedly booming. Yet corporations are failing at accelerated rates. Consumers are falling behind on payments. And at the same time, commodities are exploding higher. Silver up roughly 150% over the past year. Gold up around 75%. Meanwhile, the dollar has weakened significantly. That combination doesn't signal economic strength. It signals currency debasement colliding with supply constraints while the real economy slows beneath rising nominal prices. Markets showed that confusion today. Stocks initially rallied on the jobs headline, then reversed violently as reality sank in. Crypto markets erased tens of billions in value within hours. When markets swing that wildly, it usually means positioning is unstable and confidence in the narrative is weak. And the bond market, often the smartest market, isn't buying the strength story either. 10-year Treasury yields barely moved over the past several months despite supposedly strong employment data. Flat yields suggest investors expect economic weakness and eventual policy easing. In other words, bond traders are already pricing in the reality that revisions later confirmed. Now let's talk technical structure, because this matters for short-term behavior. Silver recently dropped sharply and briefly fell below the 150-period exponential moving average on the hourly chart, a level that had acted as reliable support for weeks. When price broke below it earlier, we saw a violent drop from near $90 down into the low 60s overnight. But after several days of consolidation, price has now reclaimed that level. The moving average that acted as resistance overhead is now potentially support underneath. Does that guarantee a rally? Absolutely not. Support needs confirmation. Price must hold above it through retests. Volume must support moves higher. But it's another piece aligning with tightening physical supply. For professional traders, it's not one signal that matters. It's confluence. Multiple factors lining up at once. And right now, several signals are starting to converge. The expanding Shanghai premium, record backwardation, rising delivery pressure heading into March notice day, technical support reclaim attempts. But let me be clear, this is not trading advice. I don't tell anyone to buy or sell anything. All I do is present publicly available information and encourage people to analyze it themselves. Because those who do their own homework start seeing patterns others miss. And those waiting for someone else to explain everything usually stay confused. But there's still a bearish case worth considering. And ignoring risks is how people get blindsided. Now let's slow down for a second and look at the other side of the argument. Because markets don't move in straight lines, and anyone telling you otherwise isn't being honest. Yes, delivery pressure is building. Yes, physical premiums are rising. Yes, economic stress signals are flashing. But none of that guarantees immediate price explosions. In fact, markets can remain distorted much longer than most traders expect. For example, even after revisions, the latest jobs report still showed around 130,000 jobs added for the current month, with unemployment hovering near 4%. That's not recession-level weakness on the surface. And markets can continue rallying off headline numbers for extended periods before revisions catch up to price action. Silver itself has shown extreme volatility recently, massive swings in both directions. And those violent moves tend to shake out traders long before actual supply shortages force delivery stress. Remember, first notice day for March contracts is still weeks away. And many traders will simply roll positions forward or accept cash settlement rather than demand physical delivery. Exchanges also have tools to prevent outright delivery failures, even in tight markets. So a crisis isn't guaranteed just because stress is visible. Then there's the temporary absence of Chinese buying during the holiday closure. Without Eastern physical demand absorbing selling pressure, Western banks and funds can temporarily push prices lower through futures markets. If that happens, technical support levels could fail again. That reclaimed moving average we talked about, it could break once more, triggering another round of liquidation before delivery pressure reappears. And while corporate bankruptcies are rising, we're still nowhere near 2008-style collapse levels. Consumer delinquency rates are elevated but not catastrophic. The economy could simply drift into a stagflation environment, slow growth with persistent inflation, without triggering a full-scale crisis that forces immediate policy intervention. And history shows something important. Paper market manipulation has persisted for decades, even when physical markets were tight. So assuming paper pricing loses control instantly may be premature. But here's the counterpoint. Every bearish delay argument assumes the paper market keeps controlling price discovery indefinitely. And that assumption is starting to crack. Because when physical markets consistently trade at massive premiums over paper prices, confidence in paper pricing weakens. Right now, Eastern markets are paying significantly more for actual metal, while Western futures markets keep prices artificially suppressed. That divergence cannot expand forever. Eventually, either premiums collapse or paper pricing adjusts upward to reconnect with physical demand. And we're already seeing warning signs. February delivery requests exceeded the total open interest that existed at the start of the contract month. March contracts now represent claims on over 300 million ounces of silver, while registered inventories remain limited. If delivery demand follows anything close to February's pattern, exchanges will face one of the biggest physical tests seen in modern precious metals markets. And unlike currency or digital assets, physical metal cannot simply be printed to satisfy demand. Cash settlement works until too many participants refuse it, so the system can delay stress. but it cannot eliminate physical shortages if demand keeps accelerating. And this is where everything converges, because now we're approaching the period where multiple signals hit at once: holiday closures, delivery deadlines, economic revisions, technical inflection points, which brings us directly to what matters most going forward. So here's what actually matters now. Not predictions, not hype, not emotional reactions, just the data points you should be watching over the coming days and weeks. First, pay attention to delivery intentions as we approach the first notice day for March silver contracts. That moment forces traders to either stand for delivery or step aside. If delivery requests begin climbing anywhere near February's levels, pressure inside the exchange system will become impossible to ignore. Second, watch what happens to the Shanghai premium once markets reopen after the holiday closure. If premiums remain elevated or expand even further, it confirms physical demand never disappeared. It was just temporarily paused. Third, keep an eye on whether silver holds above or falls back below key technical support zones. If price maintains strength while physical demand tightens, that alignment becomes difficult for paper markets to suppress indefinitely. Fourth, verify economic data yourself instead of relying on headlines. Employment revisions, bankruptcy filings, and consumer debt statistics are all publicly available. Numbers quietly adjusted months later often tell a completely different story than the initial announcement. Because here's the pattern forming. Employment data repeatedly revised lower. Corporate bankruptcies climbing. Consumer debt stress rising. Meanwhile, commodities continue breaking out despite economic weakness underneath. At the same time, Eastern markets aggressively accumulate physical supply, while Western paper markets push prices lower. Two systems telling opposite stories. And that divergence can expand forever. Eventually, reality forces resolution. But understand something important. This channel isn't about telling you what to buy or sell. It isn't about predictions. And it's definitely not about hype. My goal is simple: show you publicly available information that most people never look at. Encourage you to check the numbers yourself, and let you decide what those facts mean for your own decisions. Some people prefer waiting for mainstream explanations once everything is obvious and safe to talk about. Others prefer verifying information early and forming their own conclusions. Both choices exist. Only one requires effort. So here's the bottom line. Don't trust headlines. Don't blindly trust analysts. And don't blindly trust me either. Trust primary source data. Verify independently. Because the people who actually do the homework understand why delivery ratios matter. They understand why persistent physical premiums matter. They recognize patterns when official numbers get revised again and again. And those who don't check usually stay confused when markets suddenly move in ways they never expected. This isn't a buy signal. It isn't a sell signal. It's simply a warning. Verify or stay blind. The choice, as always, is yours. Invest with logic, not emotion. Johan AG signing off.